Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Ran Eliasaf. Ran is the founder and managing partner at Northwind Group. Ran founded Northwind Group in 2008 and oversees all company investment activities across its equity and debt strategies. Today, Northwind Group has over $3 billion in assets under management. And in just a minute, we're going to speak with Ran Eliasaf about the rise of office-to-home conversion in commercial buildings. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Ran Eliasaf. Welcome to CRE PN Radio.
Thank you for having me, Darren.
I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So I actually grew up in Israel, and I founded Northwind in 2008 after I finished my service in the Navy. I served for 6 years in the Navy as a captain of a battleship. And in 2008, financial crisis kind of emerged. And I launched a very small initial fund that targeted buying distressed debt, predominantly on grocery-anchored shopping centers in the Southeast, in Florida and Texas. I started flying a lot to the US, ended up moving here in 2012 with my wife and son. Shifted towards Manhattan real estate, did development, ground up, condo conversions. And then kind of in 2014, another evolution towards income producing value add properties, mostly multifamily and office. And in 2017, pricing and risks started to, not make sense. And we stopped doing equity investments in New York, and we started lending, basically utilizing all the knowledge we've gained on the equity side. And we started deploying capital on the debt side. And that's what we've been focused on since, mostly. We manage right now 3 debt funds, and our debt funds mostly finance residential properties in New York City and other major gateway cities in the US.
Got it. Well, that's quite a little background there from a standpoint of, so you started off in the debt side, and then you did get into the equity side and doing ground up construction.
Yes, we started on buying distressed debt.
Yeah.
Became owners of properties, then went into hardcore kind of development deals between, I would say, 2011 to 2014. In 14, we kind of stopped doing hardcore development and started doing more existing income producing value add properties.
Right.
And then in 17 shifted again towards lending. Basically, all these shifts and evolutions were the reason, or the rationale was the risk. We felt the risk was too high and the reward was too little on what we were doing before, if it was development, and then on the equity side. And since 2017, what made most sense for us on a risk-adjusted return is the debt, and providing debt, mostly first mortgages on residential properties.
Yeah, no, I love the ability to pivot like that.
It's not easy.
No, but just having the understanding that you can. I think most people I find are one way or the other. I don't know that I've talked to anybody that's been able to shift from debt to equity to and back to debt as far as the strategy goes. When you were doing the, sorry,
we try to ask ourselves a very simple question, and that is, does it make sense? And if the answer starts to be maybe, then we stop doing it. And then we think, what does make sense?
well,
And
I think
what I found out is that there is capital for any type of transaction as long as it's the right, risk profile and the right return. And a lot of the times, unfortunately, especially development deals in New York, the return profile was not adequate for the risks.
yeah. So when you initially started, you were raising capital. Did you have a fund then when you did the debt in the beginning when you were buying the distressed debt?
So the first fund I launched was on the smaller side, and we raised it from the family office. I opened shop in, so I opened up a shop inside the family office, and then we raised the initial capital from the clients of the family office, and then we went out to more, other circles. Ended up also raising capital from institutions, pension funds, insurance companies, and grew my relationships that way. It was deal by deal, and asset by asset.
Got it. And then did you ever do any kind of syndications with some of the value add strategies, or have you always been a fund model?
So yeah, so when I shifted, so the first fund was the fund that bought distressed debt on grocery anchored shopping centers. And then when I shifted to New York real estate, doing equity deals, it was really deal by deal syndication. We found a deal, it made sense. We signed a contract, and then we went to our network of investors and raised the capital on a deal by deal basis. And then when we shifted again to the debt strategy, then the first few deals were direct deal by deal kind of syndication. And then we launched our first fund, which enabled us to grow. And then since then on the debt strategy, it's purely committed funds.
Got it. And as far as the asset classes, you mentioned the original kind of grocery anchor, talked a little bit about multifamily. And were the development deals, were those primarily multifamily, or what were the development?
Some of them were condos, for sale condos. And actually my largest equity deals were office. We've done about 1.5 million square feet of office in New York City. We've bought one in 2014, then 2015, and then 2017. And we sold all of them. We sold one in 2018, and then the last office building, we had 1 million square foot office building. We sold it in December 2021. So it's a building we bought for 300 million, renovated it, and sold it for 850.
Wow. Well, that's the good math compared to some of the stuff I'm reading about now with some of the office stuff.
It was a really good execution. I have to, give credit to we were co-GP with another, superb operator, and it was just a good execution from start to finish. And the stars were all aligned. The buyer kind of came out of nowhere at the end of 2021, and we didn't expect to sell it. And the building was fully leased. We fully leased it to New York City and to the SEC, and some other, commercial tenants. And so they bought it, with 98% occupancy, with, long leases. The city and the SEC had like 20+ year leases.
Pretty strong tenant list there that you got. That's pretty good bet, I bet. All right. So, and then right now, as far as your fund goes, are you, when you're buying debt, is there any particular asset class? You kind of made the statement, does it make sense? Is there a specific asset class that you focus on for your?
We focus on residential. So over 90% of our loans on a residential, both multifamily rentals and for sale condos. About 70% of our loans are in New York City. The other 30% are in major gateway cities. So we've done loans in Miami, in Houston, Chicago. We're doing a loan in Philly now, Philadelphia. And we've only done one loan on an office building. It's been fully paid off. We don't do loans on retail properties, pure retail. We'll do a mixed use. I mean, if there's retail on the bottom and resi on top. And some of our loans are kind of pre-development land loans. But I would say the vast majority is loans on existing buildings. We do a lot of what we call completion loans. So a building, a project, either multifamily or a condo is being built. It's about 70, maybe 80% complete. And then for a variety of reasons, they need to take out the existing construction lender. We would come in, take out the existing construction loan, provide them the loan and the funds and the time needed to complete. And then our takeout is either a refinance, a sale of the building, or if it's a condo, then a sale of the individual units into the market.
Got it. Got it. And as far as that I guess the demand for your lending, have you seen an increase since 17?
We've seen a huge increase in the last year and specifically in the last 6 months. And it's mostly driven by the fact that commercial banks have scaled back dramatically, and some of them have stopped completely lending, since we had the crash of Silicon Valley Bank, Signature, and First Republic. So a lot of the banks are on the sidelines, and that opens up the field for debt funds like ours to provide the capital needed. So we see a surge in the need side, on the demand side for our loan product. We're obviously more expensive than a commercial bank because we manage the funds of our investors. But we could be more flexible, and honestly, in these days, our main advantage is that we're open for business and we're lending.
Yeah, no, there's always the you can talk all the rate you want, but if you can't get the loan, it doesn't matter. Got to be able to get the capital. What's an average length of term on the loans you're doing?
Our loans are typically 1 to 3 year term. We can go slightly longer. We normally wouldn't do shorter than a year. And the rates, start at SOFR +5 and, all the way up to SOFR +8 or 9 if it's a, high risk or kind of more complex execution. So pretty standard for a bridge lender.
Got it. And as far as the structure of your capital, is it 100% investor raised capital that you're lending, or do you guys then have any
committed
kind
funds? We manage closed-end funds, so it's a closed-end fund on a commitment basis, and about half of the capital in our funds is committed from institutions, insurance companies, pension funds, and then the other half is, family offices, ultra high net worth, and some foundations.
Got it. Got it.
And
So
IRAs, also raised from IRAs. People can invest through their IRAs as well.
okay, what's like a minimum investment for your funds?
$500,000.
Okay, got it. So let's talk a little bit about the office or the office space here, the asset class.
So office, I'll talk mostly about New York City, but it's
Okay.
relevant to most major, urban markets in the US. What we're seeing is that the Class A office buildings are doing okay, and some of them are even doing phenomenally. And then the real pain starts in the Class B, especially, dated properties and in secondary locations. Even if it's a major market like New York City, if it's a secondary location like south of Times Square in the Garment District, if it's a mid-block building, those are suffering. Financial district to a certain extent, and the pain is not only in the equity now, it's also on the debt side on some of these projects. So if somebody bought an office building 5 years ago, paid $600 a foot, put some more money in the renovations, took a loan of about half that, so it's conservative leverage at the time. Maybe the loan is $300 a foot. The problem is, if it's a Class B property, it might be worth only $300 a foot or maybe less. So we're starting to see keys being handed back to lenders, and we're starting to see loans being impaired, and there's serious trouble. And one of the topics we wanted to discuss here is office to residential conversions. So the first thing, not every office building can be converted to resi. Some of them are too deep with the floor plates. They don't have the right air and light, especially if it's a mid-block building. Maybe the column spacing is limiting. So a lot of these office buildings simply cannot be converted to resi. or they can maybe, but it's not going to be economically to do it. And then the others that size well, that can, it's a very complex undertaking. Sometimes you have to create light shafts, so you have to open, these, atriums inside the core to create the light and air. You have to move risers or open up risers. Sometimes you have to, realign the elevators, lobby, entrance, a lot of, complex, heavy work, replacing the windows, installing the HVAC systems. So it's a big undertaking. It's probably more complex to convert an office building to resi than it is to build ground up. And the thing is, you have these unknowns. Once you open up the walls, you have these, unforeseen conditions, unseen conditions that's where the general contractor might spike up his pricing with change orders. So it's not easy. In New York City, there's about 6 million square feet that's being converted right now from office to resi. And that's great, but that's a drop in the ocean compared to the vacancy that exists. The statistics talk about, 15 million square feet vacant, maybe a little bit more. So maybe 10% of it gets converted. What happens to the rest? Hopefully the market bounces back in a few years. It's going to take time, probably going to take 2-3 years. I believe work from home is not going to stay. People are more efficient working in the office, but it's going to take time to do it. And in that time frame, this next 2 to 3 years, there's going to be a lot of pain. And unfortunately, some properties or some property owners won't survive. If somebody bought a building in the 80s and 90s, has an unlevered or very low leverage, that's not a problem. They're going to see to the other side. But the problem is, whoever purchased in the last 5 or even 10 years, probably overpaid and probably over levered, and now he might be in trouble.
Yeah, on all that, it's hard to argue with, if you got a vacant building and you got to refinance or something like that, I could see the keys going back to the bank. With the financing that you guys are involved in, have you had any of these types of conversion projects presented to you?
Yes, we've looked at a couple, even more than a couple. We've looked at 3 or 4 just in the recent few months. We have not transacted on any of them yet.
Well, because you mentioned, numerous challenges, from the windows to light, and just the reconfiguration. Is there any kind of a shortcut or any kind of an easier way to identify a building that is a good fit for conversion as opposed to one that's likely not?
Yes, there are a few. So a corner building would fit much better than a mid-block building. Then floor plate, you want the floor plate on the smaller side. So under 10,000 square feet floor plate is much easier to convert than it is 20,000 square foot floor plates or bigger. Column spacing, it's really important. You want wider column spacing, if you have 20 feet, that's great. And then what's the current HVAC systems and the current locations of risers and elevators? Those are, I would say, the top things you need to look at.
Do you think that as we go forward, that the ability to convert a structure from one asset class to another will be more baked into the design based on this?
I think that we're not going to see a mass conversion without some sort of structured incentives from municipalities. You need to create some sort of tax incentive on the property tax side, especially in a city like New York, where property taxes takes a big chunk of your P&L. So I think that's where we need to focus. And again, a city like New York has a supply shortage right now of resi. Nobody's really built new stuff since COVID. Maybe a handful of projects. Really, everything we're financing, most of it is properties and projects that started pre-COVID or right in the beginning of COVID and are now, getting towards the finish line. But in order to create a mass conversion, you need to create incentives for developers to do it. because most projects on their own, very marginal on their profitability,
Right.
especially with the high interest rate environment we have right now.
Right. No, I mean, that's kind of I think it's partially by design. They're trying to slow everything down, but it does make it difficult for anything to really pencil.
Well, think about it. You're slowing construction down. What you're really doing is limiting new supply. Cities are growing, population is growing. You're not adding more supply. So what happens to the rent? Rent goes up.
Right. Right.
And then you create more inflation. I mean, people spend more than a third of their salary on their housing, right? Some people spend 50%. So if we don't create more supply, affordability won't happen. It doesn't matter where interest rates will be. The interest rates can be 20%. If you don't create more supply, you're not going to stop rents going up. And right now, you have a double whammy effect where, because mortgages are expensive, so people buy units less. So guess where they're going? They're going to the rental.
Right.
So you have any more people looking to rent on a reduced amount of inventory. So demand is up, supply is down, prices go up. It's basic economics.
Yeah, no, I love the supply and demand where they meet. That's the market, kind of pretty easy. Let me ask you, during COVID, there was at least a sense from afar that New York City had a lot of people moving out, that either going south, or it was kind of more like a remote work. People were fleeing, kind of thing. At least that was the what was.
It was true. It was true
reported
for about 2 years. It changed dramatically.
Okay, and so now, I mean, obviously,
back.
okay,
You walk, the sidewalks are full, hotels are full, tourists are back. People are not back in the office. That's the only thing that's missing. I mean, I think usage-wise, the numbers are around 60%. Again, some buildings are doing better than others, and most firms are back 3 days a week, not full, 5 days. We're back 5 days a week, but most firms are not. So that's the only thing missing. But the city is back. You feel it on the streets. You feel it in retail. You feel it in hotels. Occupancy is over 90% in hotels. Average daily rates are high. Restaurants are full. But and maybe the most important data point is the city is growing again. After it lost 40,000-50,000 people a year in COVID, now the last statistics I saw is that the city is going to grow about 100,000 people in the next 2 to 3 years. And I'll throw one more data out there. So it's growing. It's going to grow by about 10,000 people. Let's say in 3 years, it's only adding about 6,000 to 8,000 units a year. It's not enough.
Not keeping up. Yeah. So you mentioned kind of the local government, kind of one that can really kind of juice the demand and the supply from the standpoint of if they ease restrictions or make it easier to build. You feel like that would be a big boost to the supply side?
2 things they can do or should be doing. One hard and one is easy. The hard one is, reduce price of land, right? How can you do it? It's very difficult unless you want to create, kind of joint projects that the city provides the land for free, so to speak. In exchange, the developer builds it. It's like a BOT, kind of build, operate, and then transfer back. So sort of what they did in the 60s and 70s. That's less likely to happen. Where it's more easier, although it would be ideal, right? Provide the land and let's build. What's more easier is providing tax incentives and creating, bringing back programs like 421A, where you get a tax break or you get a protection against tax escalation for 10 or 15 or 20 years. In exchange, 20 or 30% of the units have to be affordable, right?
Right.
All these programs should be reinstated and pushed hard. So it creates an incentive for developers to build. Right now, where land prices are, where cost of material and construction and labor is, and interest rates, doesn't make sense to build, really. Right.
No, it goes right back to your question there. Doesn't make sense, and that's a no. So let me ask you, you mentioned these tax incentive programs. Are they currently not in place in New York City?
421A expired,
Okay,
and politicians are fighting over it, and it has not been reinstated. So it's currently expired.
got it. No, that's you know, I've always viewed tax policy as kind of a means to creating behavior, and you know, when used, that's kind of, you know, people will go towards that. That's beneficial to them. So if you can incentivize the construction, that would solve for your homes, or the demand for homes, and it seems like a win-win. So on, just trying to think here, on some of these conversion projects, can you describe kind of the timeline one would be looking at, as opposed to if they're going ground up new construction? We talked
It
about
takes
some of the
about the same
challenges.
time. It's gonna
The same?
take up to 3 years to do it.
Okay, okay. And as far as the no, in New York City, is there much of a boom and a bust cycle, just based on the constraint of land? Is there,
It's more volatile than people think. But then if you look at residential, in 2008, for example, the market almost completely stopped for 6 months, no transactions, and then it bounced back really quickly. So New York is volatile, but it's shorter time frames, and then it bounces usually before and faster than other markets in the US.
got it, got it.
But then you have certain segments where you have a pain point that takes time to solve, like retail, which hurt for the last 5 years and now is finding a new equilibrium. Then it was hotels. Now it's obviously back. Now it's office. So every time you have an asset class that kind of suffers a bit, where there's some sort of shift that happens from an external reason, right?
Oh, got it.
Retail because of e-commerce, hospitality was COVID, office is now, you know, work from home, post-COVID. Every time there's an external reason. So these risks, these black swans, they happen and then they hurt a certain asset class. Residential is a bit tougher to disrupt because we all gotta live somewhere. But even that, usually what hurts resi is supply, oversupply, which is true right now, maybe in some other parts of the country. Maybe South Florida is starting to be an oversupply, maybe some parts of the Southeast. New York right now feels undersupplied.
Right. Well, and I think New York's such a unique marketplace, just based on the concentration of people and demand, and you know, the more of the vertical city rather than the spread out.
So it's a
kind of
financial, it's a global financial center. It's a
Yeah,
global political center with the UN. It became a global tech center. It's definitely a cultural center. So there's a lot of an academic with, you know, top-notch universities. So there's a lot of reasons, different reasons for people to be in New York.
right.
Hard to
Right.
recreate this market, probably impossible in our lifetime.
No, agreed. Agreed. Hey, Ron, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we'll look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize, then we look to see if there's a way we can transfer the risk. That's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. It could be the market, the Fed, you know, supply chain, whatever it is that you're focused on as far as risk, and identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Ran Eliasaf, what is the biggest risk?
Our biggest risk is determining the value of the collateral we're lending on. It's never a scientific answer. You can get all the appraisals you want, third parties, and have your internal knowledge, but eventually a value of an asset is only what somebody else would be willing to pay for it at a certain point in time. So we spend a lot of time underwriting and diligencing and trying to determine what's the value and then what's our LTV, what's our loan to value. And that's where we focus most of our engine. That's the biggest risk, because if you gave a loan and you thought you were at 50% LTV, and then you realize you're at 80 or 90, then that's a big problem. That's a big risk. What we do to mitigate that risk, first of all, we lowered our LTVs. If 2 years ago we landed at 65% LTV, now we're more at around 54% LTV. Two, we kind of focus on asset classes that are less volatile, like residential in New York City, where there's, prices can shift, but the chances of, the value of residential in New York dropping 50% is less likely than it is for an office building, for example. And that's where the biggest risk for us is, and that's where we focus on.
Got it. Hey, Ron, where can the listeners go if they'd like to learn more or connect with you?
So they can follow on LinkedIn, my profile on LinkedIn, my name, Ran Eliasaf. And if anybody wants to connect, he can message me there, and I always try to respond in a timely manner.
Awesome. Well, Ron, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.